Okay, we have a lot of good information to get through, so we'll get started now. But thank you again, everyone, for joining us, and welcome to this full morning, afternoon training on applying the IFRS Sustainability Disclosure Standards. I'll note that this is a collaborative effort. We're working alongside the IFRS Foundation, who are a great partner, the IFC, Bloomberg Philanthropies, who are supportive of our work. And it's really demand-driven by exchanges and by participants. We've trained tens of thousands of people on this course and with dozens and dozens of exchanges. To that, thank you to the participants again for joining us from all over the Philippines for today's training. Now, I want to as well say a big thank you to Mr. Raymond Monzon, President and CEO of the Philippine Stock Exchange, who's been now in the role for, I want to say, 8 years or 7 years, 7 or 8 years. He's a long-serving a member of the Philippine Stock Exchange team, previously chairman of the Audit Committee, and some other committees as well. It's a pleasure and honor to have you here with us today. So I'd like to turn it over to you for any opening remarks. Thank you, sir.
Thank you, Landon. Good afternoon. It is my pleasure to welcome you all to this Philippine Stock Exchange, or PSE, workshop on IFRS Sustainability Disclosure Standards. More and more jurisdictions are adopting these sustainability reporting standards as a 2030 target to reduce greenhouse gas emissions by 43% is fast approaching. PSE is committed to creating a sustainable capital market that will benefit listed companies, investors, consumers, and indeed future generations. We continue to espouse the idea that sustainability holds many opportunities for operational efficiencies and medium to long-term cost savings on the part of the reporting organization and its supply chain. It challenges organizations to upskill their personnel, innovate their processes, adopt new technology, and engage stakeholders more deeply. As a member of the Net Zero Financial Services Providers Alliance, we made time-bound commitments to reduce our greenhouse gas emissions by 54.6% by 2033 from a 2023 baseline year. These commitments have motivated us to enhance our data collection processes, monitor our progress accurately, and take concrete steps to reduce our carbon footprint. The exchange, being itself a listed company, will be reporting its sustainability journey to its stakeholders using the IFRS Sustainability Disclosure Standards, which serve as a global baseline for primary users of general-purpose financial reports. Through this training session, we remain committed to a vision of a more sustainable future as we partner with our stakeholders to heighten awareness and understanding of sustainability principles. As you may already know, the Securities and Exchange Commission announced its intention to likewise adopt the IFRS Sustainability Disclosure Standards, and hopefully this training session will help get you started in your transition journey to the new standards. I would like to thank the United Nations Sustainable Stock Exchanges Initiative, or UNSSE, for their remarkable support in organizing this webinar. The UNSSE was very helpful in the preparation of our very first reporting guidance entitled ESG 101, a reporting guidebook. We published this reporting guidebook early this year and it's accessible in our website. I would also like to extend our appreciation to the resource speakers from the UNSSE, the ISSB, and the International Finance Corporation, who will provide expert advice on these IFRS standards and guide you in your compliance exercise. Finally, thank you to this afternoon's attendees for taking time off from your busy schedule to attend this workshop. I wish you all an interesting and productive afternoon.
Great. Thank you again, sir, for the opening remarks and also highlighting the longstanding partnership and relationship between the UNSSE and the Philippine Stock Exchange. It's always been a pleasure to work with members of your team, your organization. So thank you for that, and thank you for the opening remarks. So as we move along, next piece is on housekeeping. All participants are on mute to keep things easier. But of course, we have the chat open, and it's open as well for when we run polls for question and answer. We use that little button you see on your screen. So that instead of raising your hand and asking a question via audio during the session, you can use the Q&A function. It also helps us track and organize questions better. Excuse me. So please use Q&A for any questions you have. So the chat is just there if you maybe have an issue or comment, but for questions, please use Q&A so that we can make sure we get to answering your question. Otherwise, the questions get lost in the chat, and we also use the chat for sharing links and all of that sort of thing. So for today's workshop, it's a live facilitation, of course, for 3.5 hours, plus homework, which we'll talk about more. As mentioned, it's live Q&A throughout. One of the unique benefits of this session is that you have access to various experts on the sustainability disclosure standards from the IFRS. So please take advantage of that and ask all your questions. You can upvote as well, so that if someone else has asked a question, you can upvote that question as well if you have the same one. It's also interactive. Participation is expected. So we have mentees, which are interactive questions. We have polls, and as mentioned, we have homework. So the homework assignment is not mandatory, but we do highly recommend it so that you can get a better understanding of how to take some of the case studies and bring them into maybe your business or in a real life case study. It's also certified. This course is CPD certified. So at the end, we'll provide more information, but essentially there's a feedback survey. We recommend finishing the homework before. When you fill out the feedback survey, you will get your certificate, and we'll mention more on the certification after or when the session is closing. And you have 1.5 hours as well to complete the homework. Now, moving to some quick introductions. I'm Landon. I'm an SSE project officer. I'm also joined by SSE senior specialist Lois Guthrie. It's a pleasure to be doing the training, as always, with Lois. And then we have, from the IFRS, as mentioned, a couple of subject matter experts. So we have Robert, who's a partnership manager on capacity building. And then we're also joined by Vanessa, who's a capacity building fellow. So it's a pleasure to have both of them with us today. So to start introducing the subject and the material that we'll run through today. So we have some learning objectives. We want to understand the ISSB standards. What are they? Understand how to use the ISSB standards, and identifying what steps can be taken to develop a disclosure plan applying the ISSB standards. So when we break this down and we take it step by step, we have different modules. So we start with prepare, and building on existing knowledge. What is the purpose of the standards? What's the landscape of the standards? And what's the global baseline? Then we have a line setting the direction, the railroad tracks, so how to apply and use the standards. And then we have additional disclosures to add, and then implement. So what are the practices and systems? So identifying, evaluating, and integrating. And then our final module and component of this training will be on communication. So the final format of how you communicate to various stakeholders internally and externally. What's the location and timing of your communications, how to be efficient, and the confidence that comes with good disclosure. So to do this, this is the brief overview of our agenda. So as mentioned, we have 3.5 hours together today. So we have some break and activities throughout. Again, it's meant to be interactive. Please do ask questions throughout using the Q&A function. So with that, I also want to mention that we have loads of training materials. The slides and homework are that you can reference during and after the course are available on the website, and the homework assignment to develop a draft disclosure plan for your company using what you've learned in this training program is available as well. As I mentioned, you don't have to submit this. It's not a mandatory assignment. You'll find a link in the chat box for this. It's for your own learning and to build experience, and it's meant as a starting point for conversations internally. We also have the UNSSE toolkit, which includes model guidance. This goes further into detail for the 4 units we discussed today. So any topics you wish to find additional resources on or read more about, you can make use of the SSE model guidance on our website. We also have 3 additional training tools, one on transition plans, which is an intro to what transition plans are, how to get started with key resources to help companies just starting or interested in starting to work on transition plans. We also have a training tool on climate-related metrics, which offers additional support on metrics for climate going beyond the guidance in S2. We also have a gap analysis checklist, which can help you to understand what disclosures are missing and how to chart a path forward. So with that, we get to one of the first interactive parts of today's session, a first Menti, which we'll share in the chat. So we're just curious, why did you join today's training and how much do you already know? So you can use the slider to measure how comfortable you are with each of the following tasks: understanding the ISSB standards, your understanding on how to use them, and identifying what steps can be taken to develop a disclosure plan applying the ISSB standards. So we'll just give you 1 minute or two to navigate to the Menti and to input some of your answers. Okay, so looking at the first question in 3 words, tell us why you joined today's training, which about 150 folks have answered. So that's great. We see a lot, learn, knowledge, compliance. Yeah, compliance is of course big. Adopting, absolutely, developing. So that's great. It's always interesting to see how that comes together. Um, Now, going to the next question, we'd love to see how comfortable you are with each of these tasks. So you can use the slider and just go along with how comfortable you are explaining to team members what the ISSB is, using the ISSB standards, and on sustainability reporting strategy. And we definitely don't expect you to be experts already. That's part of what this training is for, is to help develop your expertise on this subject. Okay, so we see it seems to be coming in at about a 2, which we think is pretty typical. So that's not abnormal at all for these sessions. So we'll just go back to the slides if you give me 1 second. Great. So thanks for participation on the first Menti. And we'll be coming back to more of those mentees as we go on. But it's great to see the interest. And as I said, just because you might be at 1, 2, or 3 or whatever now, hopefully at the end of the session, you'll have improved your knowledge and taken something away from this training. So just a disclaimer, I'll leave this a moment for you to review, but just to be clear as to how we're using the examples today, they're very simply to help add some color to what we're talking about. Sometimes it can help to see a real example to put into practice the discussion. However, the examples should not be seen as the best way or even the right way for your company, remembering that each company has unique circumstances and should do what best suits those circumstances. You can, however, use these examples as inspiration as you get started. So with module 1, prepare, building a solid foundation of knowledge. So building on what you already know, like the standards are building on this existing knowledge and framework. So with this unit, and this is being the first unit, we generally like to cover 3 important aspects. Why disclose sustainability-related information, how the landscape of disclosure guidance has evolved to reach the ISSB standards development, and finally, an overview of the standards. So in this first unit, to build this solid foundation, we cover purpose, the case for and purpose of sustainability reporting, including the market and business case for sustainability reporting. We cover the landscape. Minor slide issue there. But we will cover the landscape, how the reporting landscape has evolved, including how it is becoming simplified and global baseline, the core concepts and requirements in IFRS S1 and S2. Now on prepare and purpose, to get started with the why aspect, by looking at the purpose or the why element, we'll first dive into the case for disclosure and the market drivers. With that, we're going to do our first Zoom poll. So that should pop up on your screen shortly. So what are your reasons for disclosing sustainability-related information? So if you just give 1 second, I'll make sure that launch. Okay, hopefully it's on your screen now. So what do you think are the reasons for disclosing sustainability-related information? Multiple choice. So to be clear, you can select more than one option if you think that's correct. Okay, good participation here. We really appreciate lots of folks participating. We find it makes it a more engaging session for everyone with lots of participation. So I'll give it another few seconds if you haven't answered the Zoom poll yet to pop in your answer or answers. Okay, we'll end the poll there. So I'll share the results. Great. So you can see for reasons for disclosing sustainability related information, a lot of individuals and participants selected regulatory requirements, about 93%, sharing management's objectives, about half, a few answered peer pressure or social expectations. In second place was investor interest with 61%. A few of you noted you're not disclosing this information yet. Hopefully this training helps you to start disclosing that information soon. But the correct answer is all. So all of them are correct. So, I wouldn't say a trick question, but investor interest, sharing management's objectives, regulatory requirements, those are all good and correct answers. And there can also be other answers and other reasons for disclosing. So we've seen more than 5,000 signatories now representing more than 128 trillion US dollars in assets under management by signatories of these principles. These are the PRI principles. So, one answer there was for the Zoom poll was on investor demand. And here you can really see investors are demanding for more attention to be focused on sustainability disclosures. So you might ask, what is driving this interest in the investor community? So what I think is important to highlight is a key driver behind this demand is indeed financial effect. This is from a study of retail investors done by Morgan Stanley, where they found that the top driver of at least individual investors driving their interest in sustainability investing was financial performance. You can see that 74% were interested there. You can take a closer look at this study by following the link in your handout, but we'll look a bit closer before we move on as to what we mean by financial performance. So it's important to remember that today we're talking about disclosing financially material sustainability related information. While we discuss more in depth in the workshop what the word material actually means, we want it to be clear from the start what sort of financial effects investors are looking to have more information on. So let's start with the effects on a company's performance, which is often seen in the statement of profit or loss, showing income or revenue and expenditure. Sustainability-related risks and opportunities can have a financial effect on this profit or loss statement by changing the revenue or mix of total revenue of a company if demand for products and services change or production capacity is disrupted, as an example. We could also see substantial changes in expenditures if, for example, operating costs increase due to, say, energy prices increasing, or a need for greater research and development expenditures or R&D to capitalize. No, I'm not sure what's happening there. Apologies. To capitalize on sustainability-related opportunities or other costs associated with deploying new practices. You will also probably hear us talk today about effects on a company's financial position. So let's look a bit at what that means. We can often see a company's financial position on their balance sheet, also known as statement of financial position. So, for example, a company may experience changes to certain assets or liabilities. They could see those changes based on certain assets or liabilities due to climate or sustainability issues. We might also see changes to portfolio value, or you might even see write-offs of certain assets that are damaged, perhaps due to climate change or something related, or the need to reprice assets. Another financial effect that should be documented is changes to financing and the cost of capital, which can include, for example, insurance premiums that increase due to climate risks, i.e. flooding, as well as making use of new financing structures such as green bonds or social bonds. And before we move to the next unit in this model, I just want to flag two important aspects of sustainability-related risks and opportunities, which are essential to understanding of them and disclosures. As you can see here from the latest Global Risk Perception Survey from the World Economic Forum, risks evolve over time. Something that may pose a significant risk 10 years from now may not be very high on our mind today, but it might be very important in the future. What's quite important for our disclosure is that if we're to be prepared for that risk that we're expecting to arrive in, say, 5 or 10 years, we might have to invest today in new practices or processes to mitigate negative impacts and increases our chances for positive impacts in the future, which means we might have financial effects much earlier to mitigate future issues. So keep in mind during our training today, the aspect of time. Another important aspect of sustainability-related climate-related risks and opportunities is their interconnectivity, which you can see here in that image. This is also from the World Economic Forum Risk Report, and as you can see, there's many connections between risks. Many people think of the two ISSB standards as separate standards, one for climate, one for other sustainability topics. However, as you can see on this slide, these are all interconnected with risks and opportunities, and therefore separating out one topic or theme doesn't remove the connections. We still have to consider the whole when making strategic decisions. Similarly, the way we deal with many of these risks and opportunities can and should be connected. So in disclosing information about climate-related risks and opportunities in accordance with IFRS S2, preparers must also comply and apply the requirements on IFRS S1 in as so far as they relate to the disclosure of information on climate-related risks and opportunities. And I'll turn it over to my colleague Lois to take us through this next section.
Thank you, Landon, and hello, everybody. So we've heard why sustainability-related reporting is important because of the risks, because of the interest to investors, and so on. So now let's have a look at how the standards have developed in the reporting landscape. But before we do that, let's ask you a question via Zoom. And the question is about what frameworks you are currently using. So hopefully the Zoom appears in a moment. So you can choose as many of these as are appropriate. Are you currently using the CDP questionnaire, the Global Reporting Initiative Standards, the Integrated Reporting Framework, the Sustainability Accounting Standards Board's work, the Task Force on Climate-Related Financial Disclosures recommendations, the United Nations Global Compact Principles, or anything else? If there is anything else, please do tell us in the chat. We will give you a minute more to think about that. It's always interesting to see what you're currently doing. I can see we've got nearly 50% of you participating, and there's a pattern emerging. So I'm going to end the poll, share the results with you. And you can see that 62%, most of you using GRI, the Global Reporting Initiative Standards. I think the next one is integrated reporting, and others using a variety of the other frameworks, some which we don't have listed here. So very interesting for us to see your current sustainability reporting practice. So thank you very much for sharing that. So let's move on now to have a look at the IFRS Foundation itself. What is the IFRS Foundation? The IFRS Foundation is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable and globally accepted accounting and disclosure standards. So at the bottom of the screen, you can see that the IFRS Foundation hosts two independent standard setting boards. The International Accounting Standards Board, which was formed in 2001. They do accounting standards, and their standards are in place in 140 jurisdictions around the world. There's also the International Sustainability Standards Board, whose work we're talking about today. It was formed in 2021 and it released its first two standards in June 2023 following strong market demand. You can actually watch the board meetings of these two standard setters if you wish. They're available from the IFRS Foundation website. They work very closely together to make sure that their standards complement each other. The work of the two standards board is governed by trustees, and they are in turn accountable to a monitoring board of public authorities. So how did all this happen? What was the evolution of these reporting standards? Well, all of the organisation whose logos you see here have contributed to the evolution of sustainability reporting. They actually have a lot in common, with most, apart from the GRI, focusing on meeting investor needs for sustainability information. But sometimes the range of objectives and guidelines and standards on offer has caused confusion. But this image represents a picture of harmonisation and simplification as indicated by the arrows. So some of the organisations, you see at the bottom, the Climate Disclosure Standards Board, the Integrated Reporting Council and the Sustainability Accounting Standards Board, their work has been consolidated into the IFRS Foundation. The standards were actually, or at least the climate standards, was very much built on the TCFD recommendations. So those of you already using TCFD will be very familiar with the architecture and content, particularly of the climate standard. CDP has aligned its climate questionnaire with IFRS S2 on climate disclosure, and the Task Force on Transition Plan its work is now under the responsibility of the ISSB, in particular the disclosure-specific materials. The GRI and ISSB, they've jointly committed to identifying and aligning common disclosures and are working closely together, as we'll see a little bit later. So this is a picture of harmonisation and simplification. Now let's go to another Zoom poll now. And some of you are using the TCFD already, we saw from the poll earlier, but this is the question for you, please. Companies who disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or false? Give you a minute to think about that. Yes, nearly 50% of you now. So let's end the poll and share the results. We asked this question to a lot of people who participate in our training, and I think participants today, this is the best answer that we've seen, because 67% of you were correct. It is false. Often we see people are a bit unclear about the answer to this, so very well done to the participants today. It's false. You can't assume that you automatically comply with the ISSB standards if you're currently using the TCFD recommendations. And I'll show you why now on the next screen. The TCFD's work culminated in July 2023, and the ISSB has taken over responsibility for it. And in fact now monitors the progress of companies' climate-related disclosures. They issued a document about this in 2024. If you're interested in that, it's on the ISSB website. Now, having said that, companies that can already report to TCFD and are required to do so in their jurisdiction, they should continue to do so, and they should be reassured that they'll be a long way towards conforming with the IFRS S2 on climate disclosures, because actually, although there are differences, they're really quite similar. ISSB and TCFD. There are three main differences. The first is that different wording is used, but with the same meaning and to capture the same information. The second difference is that the same type of information is required by the ISSB, but with a bit more detail. For example, with the questions on the resilience of your strategy, ISSB asks you for details on whether the company has the capacity to adjust and adapt its strategy and business model over time, whereas that wasn't asked by TCFD, but it's the same theme. And thirdly, the ISSB asked for some additional requirements, for example, for companies to use industry-based guidance that we'll look at later, and whether they plan to use carbon credits to satisfy targets. But you can see all the details in the document that's in the thumbnail on the left if you need to know about that in more detail. Let's talk now a little bit about the ISSB's main objective, which was to set a global baseline for sustainability information. And that global baseline would provide a common language for sustainability disclosure to enable comparable and consistent sustainability disclosure across global capital markets. And the foundation is working with jurisdictions around the world to achieve this global baseline. But of course, in addition to what's requested in or required in the ISSB standards, there may be other information that regulators, stock exchanges and others want to collect from companies. And this can be done using a building block approach, as those building blocks of additional information build on the global standard. And those additional disclosures can be required as long as information is presented in a way that does not obscure the information required by the ISSB. So what could a building block be? Well, they would involve disclosures that go beyond the remit or requirements of the ISSB and could include the type of information that GRI requests to satisfy wider stakeholder needs. This building block approach and the baseline approach is designed to reduce the need to duplicate information while still allowing additional information to be sought based on things like the GRI standards. There's global backing for this approach, that the baseline is reflected in the ISSB standards issued in June 2023. IOSCO, which is the International Organization of Securities Commissions, announced its endorsement of the global baseline and the ISSB standards and asked their 130 members around the world to consider how to incorporate ISSB standards into their regulatory frameworks. We see emerging assurance standards from the International Auditing and Assurance Standards Board to support disclosure. And as part of its regulatory implementation program, the Foundation is working with jurisdictions around the world who are planning to adopt the ISSB standards on a voluntary or mandatory basis. And the ISSB is working with market participants around the world who want to use the ISSB standards for voluntary disclosure. So I'm now going to hand over to Robert, who's going to start explaining the ISSB standards to us in more detail.
Great. Perfect. Thank you, Liz, for this introduction. Yes, we'll be moving forward, and I'll be now talking about the standards themselves, and I will provide you start with the short overview of the IFRS S1 and S2. So we've talked about the business and markets case for sustainability reporting and how the landscape is being simplified and aligned. So now let's introduce the IFRS Sustainability Disclosure Standards, IFRS 1 and S2. Before we go further, though, it's important to be clear on a few key terms. You'll find full definition in the handout, but I will quickly touch on them here. You will hear us often refer to sustainability-related financial information, and this includes topics of climate, biodiversity, and social issues, basically anything that it could impact a company's financial future. The key point here is that this is information about risks and opportunities that could reasonably affect companies' cash flows, access to finance, or cost capital. In other words, its financial prospects. So that's important to have that in mind when talking about the set and the scope of the IFRS standards. So another term we will use is general purpose financial reports. So this means that the main financial statements, along with accompanying commentary, sometimes called the management and strategic report, depending on your local regulation. All right, and on the next slides, you'll see an overview of the core content areas, and you might be already familiar with them. If you are familiar with TCFD, you will recognize that these are the same four content pillars in the IFRS and S1 and S2, and these are governance, strategy, risk management, and metrics and targets. For each of these areas, the standards set out clear disclosure requirements, and we will explore each one in more detail today, and we also encourage you to download the standards as part of your homework. Okay, and now moving to the standards themselves, I will start with the IFRS S1 general requirements. So to the preparers listening, don't be afraid. While the standards are detailed, many elements may already be familiar to you. And for accountants, much of the conceptual basis comes directly from the IFRS financial reporting, so you should be familiar with the terms used in the standards. One sets the general requirements of how companies disclose sustainability-related financial information. It lays out the structure, content, and principles, much like financial reporting standards. S1 also encourages companies to use ISSB standards and other guidance to help identify relevant risks and opportunities. ISSB's industry-based structure helps companies to find disclosure topics and metrics suited to their business model and operations. And importantly, IFRS S1 is designed to work alongside your existing financial reporting framework. On the next slide, we'll now then turn to IFRS S2. These are climate-related disclosures. So while S1 applies to all sustainability topics, S2 focuses specifically on climate, and IFRS S2 fully incorporates TCFD recommendation and sets out the required disclosure on climate-related risks and opportunities, including physical and transition risks, greenhouse gas emissions, and scenario analysis. It also includes industry-specific requirements, and like S1 encourages use of industry-based guidance to help identify relevant metrics and topics. So it's important to know that S1 and S2 are designed to work together. Even if a company only discloses on climate, both standards must be applied. So S1 sets the framework and general requirements, including the concept of materiality, while S2 builds on that with climate-specific requirements. So you may want to also understand it in a way that S1 gives you the how and S2 gives you the what for climate. So important to note that both standards work together. So now we've been moving to some conceptual foundations, which are important and also based on the similar principles which are set out in the financial reporting standards. So now let's briefly look at those core concepts behind the standards, and these help ensure disclosure are consistent, useful, and of high quality. So companies are expected to fairly present a complete picture of their sustainability-related risks and opportunities. So the information has to be complete, neutral, and accurate. And these concepts help to understand. And the fair presentation also requires disclosures to faithfully represent. To achieve this, companies shall provide a complete neutral, as I mentioned, complete neutral depiction of the sustainability-related risk and opportunities. And the reporting entity for sustainability disclosure must match the boundary used for the financial statements. And finally, the key idea is connected information. So the companies must clearly show the links between different risks and opportunities between the 4 content areas and between sustainability disclosures and financial reporting. With that, we'll be then moving to the example and the practical application of these principles. And over to you, Lois.
Thank you. And just to remind everybody, as Landon told us earlier, there is a disclaimer that goes with these examples. We're just showing them to you to illustrate possible ways of responding to some of the requirements and principles. And this example is about connected information. It comes from the annual report of a company called BHP, which is a global mining company, and it's an extract from their operating and financial review. So the extract describes the impact on the company's business strategy and capital allocation plans of climate-related risk. So I just want to point out what the connections are that we can see from this extract. First of all, there's a connection between the climate scenario analysis that they've conducted and their business strategy. They tell us that the climate risk assessments and climate scenario analysis are integrated into the company strategy and treated as a sensitivity in their capital allocation process. So connections and alignment are seen between the company's capital allocation plans and also the rapidly decarbonizing global economy. In the second paragraph, they tell us that some of their assessments on physical climate risk are still in progress, but once completed, the results will be used to inform and therefore connect with the company's risk profile, corporate planning, controls, and adaptation measures. So you can see in this example that climate change is connected with decisions on business strategy, capital alignment, and capital allocation. Finally, at the bottom of the slide, you can see a lot of light grey text, and this shows connections to further information about the impacts of climate-related risks on operational activities, GHG emissions across the value chain, financial statements, and so on. So back to you, Robert.
Great. Thank you, Lois, for this. So now to check your knowledge and understanding on what we just discussed, let's have another Zoom poll. And the question is, what information should be considered for connected information, and where the connection should happen? So whether it should be between the governance, strategy, risk management, metrics, and targets, so the 4 pillars of the disclosures. B, whether that should be between sustainability-related financial disclosures and financial statements, and C, whether that should be between sustainability-related risks and opportunities. So what we mean by connected information? And I'm seeing the answers coming in, and I see it looking good, and almost 50% of the participants from the audience participated in a Zoom poll. So you most of you're right. So all the answers are correct here. So the connections need to happen between all these elements. So A, B, and C are the correct answers in this case. So well done to anybody who answered this way. Right, and we're moving to the next topic of this webinar, and then we'll be talking about materiality. So materiality. Finally, the standards are built on the concept of materiality, which is defined by the IFRS foundations, and we will go into more details later. But just to highlight, at the moment, we'll be referring today to the material information, which is the information that is omitted, misstated, or obscured, could reasonably be expected to affect investors' decision making. So there is to the next slide. During the ISSB consultation, we on the exposure drafts, on the key feedback topics, it was important. The importance of supporting preparers was highlighted, particularly those with more limited resources and those in emerging markets. So in addition to the standards and application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including IFRS Knowledge Hub. We are also in the process of gathering examples of case studies provided by our partners. The ISSB standards are now aligned with the IFRS S2 to help preparers seeking industry-based guidance, and the FSA credential was also updated with more planned to come. So there's also a capacity building program run by the IFRS Foundation. So it's also the key part to support preparers, and the ICC training initiative is one of the most important deliverables of this program. Right, and then we'll have another simple in this webinar. The question here is a bit more specific. So let's assume the water is a vital input to your business, but the ISSB standards do not currently have a specific standard on water. What do you need to do? And the answer A, do not disclose anything about the water. B, consult the sources of guidance listed by ISSB. C, engage a consultancy to help. And D, copy your competitors' reporting. And then, yeah, in the context of what we just discussed, please then try to answer this question. And I also see the answers coming in, and they're indeed looking pretty good. And we have more than 50%. So I'm going to end the poll at the moment. Yes, and you're correct. So the right answer is B. You should consult the sources of guidance listed by ISSB. So if there is something which is not, there's no specific guidance on the specific topic in the standards, you should consult the other sources of guidance. Also need to mention that the C, might be helpful. So that's something which you should shy away. There's of course seeking out the help of consultancy. That might be something useful for your purposes as well. All right, and with that, I'll be now handing over to Landon for the summary of the module 1. Over to you, Landon.
Great. Thank you so much, Robert, and for taking us through that. So as we wrap up this module, let's just take a few minutes to review what we covered. And first, we reviewed the purpose of sustainability-related disclosures. And a key takeaway we hope you leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related financial information. If you're not aiming to make good use of the data you're collecting to improve your strategic decision-making, you're simply going about this all wrong and wasting your time. If you have operations in difficult to abate or high impact sectors, your competitors could disclose those risks and identify opportunities they're pursuing, leaving your investors wondering why you're lagging behind, and that might affect your ability to raise funds. Next, we looked at the evolution of disclosure standards and the the formation of ISSB and the aim to simplify this disclosure landscape. When you're thinking about other voluntary disclosures, you should also not see them as competing with the ISSB standards, but rather building on top of them. Finally, we introduced the standards and important concepts you need to understand in order to use the standards correctly. A key point I want to reiterate here is that these standards and the guidance that comes with them are designed to meet the needs of investors and are therefore heavily focused on prospects that we discussed at the very start of this unit. So we're going to move along to another Menti activity of how you'll define the objectives for your sustainability disclosures. So we'll give you a moment to start filling out that Menti as I continue explaining it. We'll have Lois, if she hasn't yet, she'll share as well the Menti. So what we're looking for is how you define the objectives for your sustainability disclosures. So setting the goals, be clear on what you are trying to achieve through your sustainability disclosures, define requirements, and consider where you are now. So those are some possible answers to consider, but we'll give you a moment to fill out the Menti. So again, what objectives are you aiming to achieve through your sustainability disclosure standards? Seeing answers come through yet, so give me 1 second. Okay, someone's saying Menti hasn't changed yet. Okay, apologies. Let me see what's happening here. Apologies for the technical difficulties. Just give me 1 moment to try to figure out what's going on here. Okay, all right. Had some issues on my side, but I see the answers are coming through now. So I'm not sure what happened there, but thank you for your patience. One more moment here to fill that out, since I know there is some technical difficulties on our side. Okay, so looking at some of the results, we see a lot of folks are answering transparency, awareness and compliance, transparency, compliance again, access to financing, absolutely. We discussed that a bit already. And transparency, performance, that's a great one. Compliance, we're definitely seeing some big themes here. So thank you for those answers. So I will mention there's some other possible answers. So as mentioned, setting the goals. Targets, what you're trying to achieve, defining requirements, and then other points to mention would just be considering your audience and stakeholder, looking to the future, and aiming to maximize internal benefits from the outset. But I ran into a new technical difficulty with the PowerPoint, but I'll turn it over to Robert if you don't mind getting started on the next section, and I'll pull up the PowerPoint in the meantime. Thanks.
Great, thank you, Landon. Yeah, so we'll be now moving to the next section and be talking about application of the ISSB standards and integrating the additional disclosures. So now that we have covered the foundational concepts, we'll talk how to actually apply the standards in practice. We'll look at how to integrate additional disclosures, whether they are required by your sector, your jurisdiction, or simply reflect your company's leadership goals or peer expectations. So in this unit, I'm waiting for the slides to be there better. So we'll see it in a moment. So in this part of the session, we'll focus on two key ideas. First, we'll look at how to use the ISSB standards to meet the global baseline. That's really the heart of this unit. And then later we'll turn to how companies can add on other relevant disclosures depending on their needs or local requirements. Landed, we can't
apologies.
see.
Apologies, Robert. Something funny happened with the slides, so if you just give me 1 second, I'll pull them back up, or feel free to continue without the slide for 30 more seconds.
Yeah, I mean, yeah, so these are sure. I mean, we have some well, so what we want to start with is how to apply the ISSB standards themselves. And the goal here is to help you understand how to meet the global baseline expectation for sustainability related financial disclosures. So it will be great to have see this slide 57. We're talking about we'll move to the first content core content area, which is governance. And the governance, this section includes information about how your company's governance body, like the board or sustainability committee, how they are involved in overseeing sustainability related risks and opportunities, and how responsibilities are assigned to management. Right. Yeah, that's the slide we're looking for. So on the next slide, and there are some questions to ask regarding governance. To help you get started, we'll go through some questions you can ask internally. These are useful when conducting a gap analysis or preparing your first disclosures. So, for example, you would like to ask who is responsible for overseeing sustainability risk and opportunities? How has it been delegated to a specific role or committee? Secondly, how often does the management or board get updated on these risks and opportunities? Great, thank you, Landon. And the other questions would be, so do these risks influence business strategy or decisions, like setting a specific sustainability targets? Is progress toward these targets linked to executive pay? So these are types of questions that support governance-related disclosures under IFRS S1 and S2. So if you're looking for good practical resources, there's a SSC checklist tool. It is a helpful place to start, but just a reminder, it's a support tool, not a substitute for the standards themselves. All right, and let's have some. We're gonna now move to another example, which will be brought to you by Lois. So over to you, Lois.
Yes, thanks, Robert. Thank you for your patience, everyone, as we wrestle with our slides. But this example to illustrate governance disclosure is from a company called Yara, which is a global crop nutrition company. Now, there's a lot of information on this slide about their governance model from the 2024 annual report, so I'll just run through a few things. First of all, we see that this is a highly integrated governance model where responsibilities for sustainability are embedded across different business functions, including risk management, health, safety and environment and quality, HR and global climate and energy. The Sustainability Governance Team reports directly to the Chief Financial Officer, and that Sustainability Governance Team are responsible for sustainability performance and reporting. You can see right at the bottom as well that the Sustainability Governance Team is supported by a sustainability network, and that again is made up of representatives from a range of functions across the organisation. There are lots of arrows on this depiction, and they're used to indicate the flow of information and input between governance bodies in the organisation. So there's no standard governance model, as you all know, and your organisation should choose a governance structure that's fit for your purpose and the particular needs of your company. This is just one example. Let's look at another example now, and it's from Toyota, which, as you know, is a car manufacturer, including of hybrid electric vehicles. This is an extract from their 2024 annual report, and it explains the role of the Sustainability Committee within the company's governance structure. So it's one of the Sustainability Committee is one of the business execution committees that reports direct to the president and the board of directors. So what we see here is the frequency with which the Sustainability Committee meets, once a year or as necessarily, who chairs the committee, and that's the executive in charge of enterprise risk and compliance management. So different to the Yara example where the Sustainability Committee reported to the CFO. We can see what the issues that the Sustainability Committee has identified. We see who the members are from a range of different activities across the organisation, and also what the agenda is for the Sustainability Committee to approve action plans on sustainability, determine the direction of the approach, and revise the sustainability policy, which they link to via a QR code in the report itself. So hopefully that illustrates two governance model possibilities, and we're going to hand back to Landon now, who's going to take us through the strategy requirements.
Great, thank you for that and those examples, Lois. So hopefully with those examples, it's helping make governance a bit more clear. So let's look at the next core content area, which is strategy. Strategy has quite a few more disclosures to include than governance, but it's really where companies can see the benefits from sustainability-related opportunities and being prepared for the risks. As you can see here, there's three high-level areas that we focus on in the strategy content area, which are first, risks and opportunities, second, effects, and third, resilience. And we'll review each of these now. So the IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of general purpose financial documents or reports to understand a company's strategy for managing sustainability-related risks and opportunities. If we first look at requirements related to sustainability-related risks and opportunities, these are some questions you'll want to be asking internally. So when disclosing information about risks, information required includes the description of the effects, the time horizons, is that short, medium, or long term, and under which of those time horizons the effects are expected, keeping in mind that the financial effects can occur before the risk or opportunity materializes and or after, and can change or evolve over time. The last two questions on this list in particular look at climate, so this aligns with requirements from S2. For example, investors also want to understand what types of risks or opportunities, and we often see companies using the categories that have already been identified by TCFD, such as physical or transition risks. Both standards include guidance to support companies identifying and disclosing risks and opportunities, for example, using the industry-based guidance and ISSB standards. This can often be easier to understand with an example, so let's add some color here and see what this might look like in practice. And this example is from Mondi Group's 2024 integrated report. So Mondi Group is a multinational packaging and paper group with operations across Europe, North America, and Africa. And at the left hand of the slide, we can see the risks the company has identified, how the risks align with four key categories: strategic, financial, operational, and compliance, and the delegated risk owners. There's lots more information about the risks throughout the report. We link the report there if you'd like to delve into this example a bit more. But climate change risks in the strategic categories are then further analyzed in the second extract on the right-hand side of the screen and are categorized as physical and transition risks, as well as opportunities. So they identify the risks through evaluation processes described in the report, and Mondi shows that the estimated financial impact ranges, time horizons, including differentiation between the onset and the full impact of the risk or opportunity, and the sensitivity of the risks and opportunity in terms of likelihood under different temperature scenarios. So I mentioned a minute ago time horizons. So another aspect of the risks and opportunities identified as having a potential financial effect that will need to be disclosed brings us back to what we discussed at the beginning of time. You might remember we discussed earlier that the time factor is something quite different when we're talking about sustainability-related disclosures. So let's make sure we're clear on what we mean by time horizons. The standards ask you to identify within what time horizon any material effects are expected to occur. Definitions of short, medium, and long-term time horizons can vary between companies and depend on many factors. They can depend on things like investment and business cycles or strategic planning horizons for capital allocation, assessment periods, the life of assets, and even some other factors. So what's important to remember is that this time horizon should be defined. So don't expect investors to know what short and medium term means, because that's a bit ambiguous or vague. Provide a quantitative definition. Let's move on now to the second grouping of disclosures in the strategy category. The first section of the strategy component relates to identifying the risks and opportunities that could be reasonably expected to affect the company's prospects. The next set of disclosure requirements focuses on what exactly that effect is and where it occurs in the business. To start tackling the disclosure requirements of the standard, companies might want to start asking themselves questions such as beginning to describe these effects and understanding the response plan for mitigating or adapting to the effects identified from sustainability-related risks and opportunities. Again, an example can help bring some color. So let's briefly look at one now. So this is a global with products that contribute to sustainability through the use or through their reduced carbon footprint. The company is prioritizing projects where they see rising demand from customers and a willingness to pay more for sustainable products, as well as transformation projects that support the company's license to operate. Amongst other things, the company is investing in renewable energy to operate their plants. So you can see that in their own production column in the middle. The S reference in the last panel on downstream value chain refers to the streamlining of the company's portfolio and supporting their global sustainability-related targets. In related commentary, the company also says that it wants to achieve 10 billion euros in sales revenue by 2030 from products that contribute to the transition to a circular economy. This example really illustrates how the company's sustainability strategy affects the business model and their value chains. Connections are made between the company's strategy, sustainability targets, technology ambitions, and the value chain and financial estimates. So we think that's a great example showing the connection between those elements. Now, sometimes one of the obstacles companies face when reporting on these effects, however, is to what detail this should be disclosed. In the example we just looked at, we were showing mostly qualitative disclosures and descriptions, but what about quantitative disclosures? A company is required to disclose both quantitative and qualitative information about the current and anticipated financial effects of a sustainability-related risk or opportunity. However, the standards also set out criteria for when only qualitative information is required. So using only qualitative information for current and anticipated financial effects is permitted if a company cannot separate the effects of a climate-related risk or opportunity from other effects, or if there's a high level of measurement uncertainty. Additionally, only qualitative information for anticipated financial effects is permitted if the company does not have the skills, capabilities, or resources to provide that quantitative information. So there's a few caveats there that you can consider for qualitative versus quantitative. Now we come to the last part of the strategy component. The first part was looking at the risks and opportunities that are going to affect the reporting company. The second at what that effect is. And now this group of disclosure looks particularly at how the company is prepared for uncertainties and ensuring its resilience into the future. This really gets into the practices and processes that a company has in place to assess its own resilience and to make strategic adjustments when needed. Disclosures include information on what type of assessments are used, how scenario analysis is used, and at the heart of it, resilience disclosure requirements ask the company to, 1, disclose its assessment of climate resilience, and 2, the inputs and key assumptions used in the scenario analysis. Just so you know, we'll dive deeper into the scenario analysis in a moment. That's often, folks often ask questions about this component or item, but some questions you consider asking internally when starting to disclose this information focuses on the company's capacity to react or adjust to the uncertainties arising and how different scenarios are being used to test this resilience. So now we'll look at an example or two of how this is being disclosed in practice. So first we have Stora Enso, which is a Finnish and Swedish forestry products company, which shows in this small diagram on the top right of the slide what sales are likely to look like in 2030. Stora Enso distinguishes between essential and growth businesses in this small yet powerful infographic. you'll see we don't have any numbers here, but we do have an immediate picture of where growth is anticipated and also the detail about the company's long-term vision and their recent transition, which they describe as quote unquote, proactively repositioning the business from largely a pulp and paper company to a renewable materials company, ensuring our future for many more years to come. They give a sense of how the growth of the business will expand through acquisition of other companies, converting machines, as well through innovation. So it's more qualitative, but it's still very helpful. The next example is Solvay, which is a Belgian multinational chemical company, and we're using this example to illustrate reporting financial effects. In particular, I want to highlight here how they're transparent about the estimates and note that they have been developed based on scenario analysis, which is indeed a useful tool when estimating anticipated financial effects, but it's not the only tool. So if you're using a tool like scenario analysis, investors need to understand how you used it. And you can see in this excerpt that they note what assumptions they've used, indicating which scenarios they considered, the business units they focused on, and they also highlight that internal experts work together with a consultant to conduct this assessment. They then report the financial impact drivers using a qualitative score ranging from -3 to +3 to indicate the potential direction and magnitude of financial effect for the different transition risks they identified. So hopefully those examples help bring to light a bit more of what we discussed. We're going to move on to another Zoom poll that I'll launch now. If you give me one moment. So the question is, a company may choose to disclose only qualitative information and/or combined quantitative information about current and anticipated financial effects when, and you can select all that apply. So A, B, C, or some combination of those options. We'll give folks a minute to answer this question. Give you a few more seconds here to input an answer. Few more seconds for any final thoughts, answers. Okay, we'll end the poll there and I'll share the results. So good news is a lot of people selected the first option A. The company cannot separate the effects of a climate-related risk or opportunity from other effects, which is absolutely correct. And B, there's a high level of measurement uncertainty. A lot of individuals selected this as well, and that again is absolutely correct. So both A and B are correct. However, some did select C, but that is incorrect. The quantitative information shedding a negative light on the company does not warrant not disclosing anticipated financial effects. So A and B were the correct answers there. Great. With that, I will turn it over to Lois to talk us through some climate-specific considerations.
Thank you, Landon. Yes, between S1 and S2, the governance requirements, for example, are very similar. There are no specific additional requirements for climate, but when it comes to the strategy requirements, there are additional disclosures required in S2 that are specific to climate. So we're going to have a look at some of those in this short section. So this slide is entitled From TCFD to ISSB, just to help you, if you are currently using TCFD, to understand what's slightly different about ISSB. However, even if you're not using TCFD currently, this list will help you understand what is different about or additional about the requirements in S2 that are specific to climate. So first thing, S2 requires a company to refer to and consider the applicability of industry-based disclosure topics. Now, these can be found in the industry-based guidance on implementing climate-related risks and opportunities, and that is available on the ISSB website. So, for example, when you look in the industry-based guidance that is itself based on ISSB standards, you'll see that there are specific requirements on climate for different industries. An example of this would be there's information asked about the use and sourcing of palm oil in the household and personal products industry. Secondly, S2 asks for details about where in the business model and value chain risks and opportunities are concentrated. So, for example, might there be a physical asset that is particularly vulnerable to physical risk, or might there be parts of the value chain that are particularly susceptible to climate risk? Thirdly, S2 asks companies to provide detailed information about the effects of climate-related risks and opportunities on their business. So this would also involve disclosing how the company has responded to or plans to respond to the risks and opportunities that they've identified. And this may involve the development of a transition plan that we'll talk about in a moment, or how it plans to develop and achieve climate-related targets. Next one is about the criteria for when quantitative and qualitative information is required. So in providing details about the current and anticipated effects of the climate-related risks and opportunities on the company's financial position, financial performance and cash flows, S2 sets out criteria for when that information is to be provided in a quantitative or qualitative form. Ideally, it would be both, but S2 says that a company can just provide qualitative information in some circumstances. For example, when it's not possible separately to identify the effect of the climate risk or opportunity, because often there are various types of considerations that give rise to the risk, or when the level of measurement uncertainty involved is so high as to make information just not useful. When preparing disclosures on the anticipated financial effects of climate-related risk and opportunity, S2 says that companies are to provide all reasonable and supportable information available at the reporting date without undue cost and effort, using an approach that is commensurate with its circumstances. Now, this, what we might call easement, is designed to recognize that providing information about anticipated financial effects of climate risk is quite tricky for many companies, and therefore there is this easement that you can just provide all reasonable and supportable information commensurate with your circumstances, and we're going to be looking at that in a bit more detail in a moment. The S2 does require companies to use scenario analysis for conducting an assessment of its resilience to climate-related risk and opportunity, but it does not specify which or how many scenarios are to be used. That is for the company to decide. And finally, there's particular information required about the resilience assessment. And they are things like, what were the specific areas of uncertainty that the company encountered when conducting its assessment? What is the company's capacity to adjust and adapt its strategy and business model over time in order to remain resilient? And details of how and when and which climate-related scenario analysis was carried out. Now, I just mentioned that one of the responses a company might have to the effects of climate-related risk and opportunity is to develop a transition plan. So and actually in S2, there is a requirement that if they have one, a company should provide details of their climate transition plan. So what is a transition plan? Well, it's defined in S2 as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emission reductions plans. So, as an aspect of the company's overall strategy, the climate transition plan should be aligned with the company's strategy, including the business case for it, the motivation for the transition plan, the levers that the company is most suited for using for decarbonisation, both economically and technologically. Secondly, the transition plan should be aligned with science, with the goals of science, with perhaps the Paris-aligned commitments, with net zero pledges, perhaps at the jurisdiction level or at international level. The plan should include long-term goals for transition that should be supported by activities and targets, mitigation strategy, and interim targets that monitor progress towards the longer-term goals. The plan should be transparent about what it is dependent upon for its success, what risks and challenges might arise in association with execution of the transition plan, and how residual and unabated greenhouse gas emissions will be treated. This transparency is important because, of course, there'll be uncertainty surrounding the transition. So transparency will make your readers aware of the particular challenges that you anticipate. The transition plan should or could follow sector-specific pathways because the transition will develop in different ways at different times for different sectors, and we'll look at some resources that might help with that in a moment. And finally, companies should consider how the transition plan is going to be evaluated by readers, including investors. And again, there are resources that set out the hallmarks for credibility of a transition plan. So let's look at some of these resources. Well, there are lots and lots of resources. We can only show you a small snapshot of them here. We're going to be, of course, we're looking at the IFRS sustainability requirements telling us that if we have a transition plan, details of it should be disclosed. But that the IFRS requirements are supported by the work of GFANZ, the Glasgow Financial Alliance for Net Zero, which is shown on the second layer of the triangle on the left, but some of the resources that they have issued are shown in the middle of the screen. So they've set out the expectations of transition plans for real economy companies and financial institutions, but they also provide some guidance on sectoral pathways for transition. There's also the work of the Transition Plan Task Force. Now, as I mentioned earlier, the disclosure-related work of the TPT is now taken over by the ISSB, but you'll find on the ISSB's Knowledge Hub, which we'll give you the link to later, this transition pathway disclosure framework, which is very useful for designing a transition plan. So lots of resources, and you can find more on the IFRS website and Knowledge Hub. But you'll be glad to hear that we're now going to take a quick break. It's just a 5-minute break. We'll play you some relaxing music. So do have a stretch, go and get a drink, and remember to keep asking us your questions in the Q&A box. We'll see you back here in 5 minutes. Hello, everybody, and welcome back. Hope you had a chance to refresh, get a drink, have a stretch, and we welcome you back. We're going to head into the next core content area now. So we've covered governance, we've covered strategy, and we're moving into a section on risk management. I'm hoping that my colleague Landon will be able to move to the next slide, or perhaps undo our break slide.
Yeah, sorry, one moment, Lois. The slides are just stuck, so.
That's okay, Landon. No worries. I'll just
Oh, there we go.
yes, here we are. So thanks very much, Landon. Let's move on to risk management. So as you can see from this high-level description, this content area asks companies to disclose information on how their process for risk management, what is the process for risk management, and also whether and how that is integrated into their overall risk profile. So this is a bit different from other core content areas in that the other content areas ask for information about things, whereas this one asks for details about a process, and in particular, what processes and policies are used to identify, assess, prioritize and monitor sustainability related risks and opportunities, and whether they are incorporated into the company's overall enterprise risk management process. So you might want to start thinking internally about what those processes are, what inputs and parameters are used for risk management, what criteria are used, is it nature, likelihood, magnitude, probability, or other things? What's the monitoring process for sustainability related risks and opportunities, and whether and how often those processes change and what's the reason for those changes. So a question about process, but in the turning now to the climate specific considerations of risk management, the IFRS S2 disclosure requirements are broadly consistent with S2, but S2 asks for more detailed information about the input parameters used to identify risks and whether and how scenario analysis has been used to inform risk identification. Scenario analysis in the standard is to be used for conducting an assessment of the company's resilience, but it is also a useful process to use to inform risk identification. And as I said earlier, the standard asks whether any of the processes have changed over time. In S2, we do have a definition of climate-related risks too, and this is taken from the TCFD's work. There are two types of climate-related risks identified in S2, and these are transition risks and physical risks. Transition risks arise from efforts to transition to a lower carbon economy, and they're often categorized as policy and legal, technological, market, and reputational risks. We've got some examples in the middle of the screen. These transition risks might be things like increased pricing of GHG emissions coming from policy decisions, enhanced reporting obligations, exposure to litigation associated with climate risk, cost of transition to lower emission technologies, changing customer behavior, and in particular increased demand for products that respond to climate related risks. And there might also be uncertainty in market signals, and increased cost or availability of raw materials. The physical risks are can be acute, which are event driven, such as storms, floods, droughts, or heat waves, which are increasing in severity and frequency, or they can be chronic, which represent longer term shifts in climatic patterns, such as changes in rainfall and temperature, or sea level rise, reduced water availability or quality, biodiversity loss, and changes in soil productivity. We see some of those examples in the middle of this slide. But in both cases, these types of risks can give rise to financial effects that affect the cash flows, access to finance, cost of capital, results of revenue, etc., valuation of assets. And these types of financial effects may be experienced over different time frames, the short, medium and long term. And of course, as we've already heard, the S2 does require information about the current and anticipated financial effects of climate-related risks and opportunities. So talking of opportunities, we also have a definition of climate-related opportunities in S2. And they include things like resource efficiency, changing to different types of energy source, so lower emission sources of energy, improving efficiency is an example of this across value chains. Opportunities also include the development of new products and services to respond to changing consumer demand, or perhaps to take advantage of policy incentives. Opportunities can include finding access to new markets, differentiating against competitors, and improving the company's resilience through resource substitution or diversification. And again, these opportunities can give rise to positive financial effects on the company's cash flows, revenues, better access to finance, lower cost of capital. And again, these opportunities are felt over different timeframes, and of course can also, as well as financial effects, you can find reputational effects and customer loyalty effects and so on. Let's look at an example of how a company called the RS Group, which is a UK-based distributor of electrical and industrial equipment, how they make disclosures about their physical climate risks. So this company have analysed their climate-related risks and opportunities for a number of years as part of their annual report disclosures. Elsewhere in the report, the company identifies 10 principal risks, one of which is climate change as a risk, and this is an extract that describes the physical risks. So the most significant physical risks relate to the impact of extreme heat on distribution sites, and you can see that on the first row there. But also the impact of extreme weather events on their distribution sites. And you can see that on the second row in this example. You can see that there's a little red wheel in each row, and this is used to indicate where and how these risks affect the company's strategy. So we talked about connection earlier, and here's a connection between the risk and the company's strategy. In the extract, you can also see the identified business owner for each of these risks, the metrics they use internally to track and monitor the development of each risk, and the actions that they are taking to mitigate the risks. Those actions include building upgrades and associated capital investments and business continuity planning. And there's much more information about this elsewhere in their report. So we're going to turn to the final core content area now with Robert.
Yes, great. Thank you, Lois. Yeah, indeed. We'll be moving to the next content area, which is metrics and targets. And we'll be now spending some time reviewing the disclosure requirements in this area in more detail. And this is the final core content area on the standards. So let's start with metrics. Requirements on metrics are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. So, for example, what is the method of calculation? What were the inputs? What are the limitations? What are assumptions? involved. And that's about metrics. And for targets, requirements and targets are designed to enable investors to understand the targets a company has to set to monitor progress towards achieving its strategic goals. And the disclosures then should include whether they are qualitative or quantitative, and whether it's set voluntarily or by law or regulation, the metric used to set the target and to monitor progress towards its achievement, the baseline period which progress is measured against, and the period to which the target applies. What are the milestones and interim targets? And the last aspect will be whether there has been any revision of the target, together with the explanation about the revision. Right, and then we have, for this specific topic, we have an example will be presented by Lois.
Thank you, Robert. And this example is from a company called CLP, which is one of the largest investor-owned power businesses in Asia Pacific that aims to be a leading responsible power provider. So this is from their 2024 sustainability report. Now, lots of the examples that we show you today are about climate change because it's one of the most advanced areas of sustainability reporting, but IFRS S1 does require companies to disclose information about all sustainability related risks and opportunities that could reasonably be expected to affect their prospects. So here we have an example about the way a company reports on targets to do with waste management and material use. So these are the metrics that are reported in CLP's report for 2024. And they're really about the percentage of pollution the company reduces through recycling and removal activities in line with its circular economy strategy principles, which are described in the top panels there. So you can see that what you have is the 2024 results of the percentage reduction in waste and material use. But you can also see whether that target is in line with the baseline target that was set in 2021, but you can also see how that compares with the endpoint for the target in 2025. So the target for waste products in the first row has slightly exceeded the 2025 target already, and that this is because of a divestment by the company. But elsewhere in the report, they also tell us that they have calculated these metrics using the ISSB and GRI frameworks, and you can see that in the very light grey text in the top panel. So a waste management and material use targets example done there, and I'll hand back to you, Robert. You're on mute, Robert.
Sorry, apologies. Yeah, we're moving to the next section. And then I'll be talking about the climate-specific considerations for the disclosures on metrics and targets. The TCD framework included a recommended disclosure, which IFRS builds on, as we already talked about, and adds to part as a part of required disclosures. So, for example, IFRS S2 requires disclosures of industry-based metrics relevant to a company's business model and activities. Additional disclosures are required on greenhouse gas emissions, including separate disclosures for the consolidated accounting group and associated joint ventures, and information about companies' financed emissions. In addition, IFRS S2 sets out Scope 3 measurement framework to provide guidance for preparing Scope 3 greenhouse gas emissions disclosures. So it's important to also remember that why IFRS S2 does not explicitly require a company to disaggregate its greenhouse gas emissions disclosures by the constituent gases. IFRS S1 includes requirements on disaggregation that would result in the disclosures of the constituent gases by being required if such a disaggregation provides material information. So I'd like to also remind everyone that you can access more information on climate metrics in the SSC training tool on this topic. We'll share the link in the chat, and you can also find it on the SSC website as well. Right, and likewise, there are some additional disclosures compared to TCFD for targets. So, for example, IFRS S2 requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. IFRS S2 also additionally requires disclosures of more detailed information on greenhouse gas emission targets, including additional information about any planned use of carbon credits to achieve a company's net greenhouse gas emission target. Also, IFRS S2 includes additional requirements on disclosed information about approach to setting and reviewing each target and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. Right, so these are those additional requirements beyond what is set out in TCFD. Let's move to the greenhouse gas emission metrics. So questions on greenhouse gas emissions often come up in questions on metrics and target disclosures. So we want to address some of these briefly. And for those who might not be familiar with the different scopes, we'll then provide a brief definition of what scope 1, 2, and 3 are. So scope 1 includes all direct emissions that occur from sources owned or controlled by companies, such as emissions from your own from your company's facilities or vehicles. Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And scope 3, the most challenging one, is all other indirect emissions that occur in the company's value chain. So in that context, S2 requires a company to disclose its absolute gross. S2 requires a company to disclose its absolute gross scope 1, 2, and 3 greenhouse gas emissions in accordance with the Greenhouse Gas Protocol corporate standard, unless jurisdiction requires a company to use a different standard. If the company is using a different measurement method, there is a transition relief to use that method in the first year of applying the standard. Additionally, what S2 requires to disclose as well is whether and how the company is using an internal price on carbon for decision making. And finally, whether and how executive remuneration is linked to climate change. These are the requirements on the greenhouse gas emissions metrics in S2 and how that can be done in real world. We have another example which Lois will talk about.
Thanks, Robert. Yes, this example is from a company called Enel, which is an Italian producer and distributor of electricity and gas. Now, Enel prepare a separate report they call their GHG inventory, and you'll find lots of details about their greenhouse gas emissions in that report. This is just a small extract from their inventory. Within the inventory, you'll see the context that they set for their greenhouse gas emissions reporting. They provide a description of the company's ambition to achieve net zero emissions by 2040 and to promote energy generation from renewable sources. So down to the specifics, though, in the top of the slide, you can see the company's GHG emissions carbon footprint broken down by scopes 1, 2, and 3. And you can, in the dark boxes, dark blue graph boxes, you can see the results for the year 2024. And in the shaded graph bars, you can see the results for 2022. So what you have here is both a breakdown of the greenhouse gas emissions by scopes 1, 2, and 3, but you also have a comparison from 2022 to 2024. So you can see the trend, and they give you the percentage decline in emissions between those 2 years. Now, you'll also notice that the Scope 2 emissions are broken down by location-based and market-based, and we'll have a look at that breakdown in a bit more detail in the panel below. Robert mentioned that greenhouse gas emissions information is to be disaggregated or broken down between different areas where appropriate. And at the bottom of this screen, we see a breakdown of Scope 2 emissions. So first, the breakdown is by business activity. So this is a breakdown for power generation and others. It's just one of their business activities. We also see a breakdown by source, by the GHG source. So it's broken down by source from electricity consumption from the grid in power plants and from electricity consumption from the grid in terminal ports in particular locations. We can also see the year-on-year comparison comparing 2022, which is the base year, and 2024, but we can also see the breakdown by calculation method, which is the location-based method reflecting average emissions intensity of the local electricity grid the company is connected to, and the market-based method, which reflects emissions from electricity, but based on the contractual terms for the purchase of that electricity. So quite a lot of breakdown there. Let's have a look at a poll now. And so please answer whichever you think are correct. Hopefully the poll has been launched and you can see it. And the question we're asking is, what is the objective of metrics? In particular, the objective of the requirement to disclose metrics. Is it to enable report users to understand performance in relation to the company's sustainability-related risks and opportunities? Is it to understand progress towards any targets? Or is it to understand the company's assumptions about the future? Give you a minute to think about this. There's a pattern emerging here, so I'll end the poll and share the results with you in the interest of time. And those of you that answered A and B are correct, and that's most of you, so well done to this audience. Now, if you did answer C, to understand the company's assumptions for the future, I'm sure that is also right in the sense that the metrics would help a reader to understand the company's assumptions for the future, perhaps. However, the point of asking you the question in this way is really to encourage you to read the standards themselves, because at the very start of each of the content elements, the standard sets out the objective of the content element. So in the case of metrics, in paragraph 45 of IFRS S1, you'll see that the objective of sustainability-related financial disclosures on metrics and targets is to enable users of general-purpose financial reports to understand an entity's performance in relation to its sustainability-related risks and opportunities, including any progress towards targets it has set. So as stated in the standard, the objective is as in A and B, although the objective C might also be satisfied. We just encourage you to read the standards because knowing the objective might help you to understand what to focus on as you go on to preparing your disclosures. So let's move on now to look at the next component of the Align module. So we've covered all the core content areas now to meet the ISSB standards, but as we've discussed a little bit earlier, there may be regulatory requirements or other disclosures that you have to or want to supply, and that's what we're going to be talking about here. So it's about how you build on the baseline. Now, we've already talked about the ISSB's baseline as setting out this comprehensive, comparable set of disclosures, but we know that that can be built upon by building blocks. So those building blocks might take the form of local requirements or listing requirements, could also affect companies in your supply chain. Those building blocks might be based on policy objectives in or policy requirements in the jurisdiction in which you operate. They could include things like subsidies for sustainable practices or tax incentives, and so on. There may be building blocks that come from industry practices or industry standards that apply to your sector, or it may be that you want to or have to provide information that is designed for a wider stakeholder group than just investors. So we're going to talk about how and why this happens. Well, we talked earlier about the fact that the ISSB is working with jurisdictions who want to adopt their standards through regulation or on a voluntary basis. I think when we last had an ISSB member on one of these training sessions, she said that there are 35 countries that are adopting or taking steps to adopt the ISSB standards. And if you're interested in this, you can see from the link here, IFRS Jurisdictional Sustainability Consultations, you can see all of the consultations on the adoption or potential adoption of the ISSB standards through that link. And the ISSB does give dedicated support to regulators that are contemplating this. So because companies report according to other standards, they might have information they want to or have to supply in addition to what is reflected in the baseline. The ISSB has strategic relationships with organisations to support interoperability so that the building blocks work well with the baseline. We've already talked about the fact that CDP has aligned its climate standard with IFRS S2. The greenhouse gas protocol is the standard that must be used for the calculation of greenhouse gas emissions according to S2. And the ISSB are working closely with the greenhouse gas protocol, both in terms of the governance of the GHG protocol team, but also on updates to the GHG protocol standard. We've already talked about this, but GRI has got a memorandum of understanding with the ISSB to seek to deliver full interoperability and seamless sustainability reporting where companies report to wider stakeholder groups and according to ISSB. We've already said that the TPT's work has been, or as far as it relates to disclosure, has been incorporated into the ISSB's work streams. And the ISSB is working now with the task force on nature-related financial disclosures as it progresses its work plan on biodiversity and ecosystem services. I won't go into this in detail because we've already talked about it. Just want to make you aware, because many of you are using GRI, about this close working relationship between GRI and the ISSB to jointly identify and align common disclosures. They've already done one project on this, which is they've published this document you see on the left explaining how their requirements on GHG emissions are aligned. And they are also collaborating to deliver full interoperability on biodiversity, ecosystems and ecosystem services, starting with GRI standard GRI 101. And in terms of governance, between the two organisations, the IFRS Foundation is a convening partner of GRI's Sustainability Innovation Lab in Singapore. So the bottom line is they work closely together. Similar considerations apply to the ISSB's work with EFRAG, which is the standard setter for European sustainability reporting standards. As many of you know, the corporate reporting The Corporate Sustainability Reporting Directive in Europe requires companies within scope to provide sustainability information according to European sustainability reporting standards, some of which overlap, of course, or are very similar to, or even the same as, the IFRS sustainability disclosure standards. So the two organisations, the European Standard Setter and ISSB, have done some work to consider how their climate disclosure requirements align, and have concluded that there is a high degree of alignment. Of course, the difference with the European standard is that it caters for the requirements of a wider stakeholder group, i.e. those that are interested in impacts, not just risks and opportunities that affect the company's prospects. And on the ISSB side, the difference is there are some additional requirements to those that we see in the European standards, including requirements on financed emissions. But I should mention at this point, there is, I think there's a consultation ongoing at the moment where the ISSB is looking at some simplification perhaps of the GHG reporting requirements. Now, we saw earlier when we did a Zoom poll with you that some of you are using integrated reporting, which is very useful. And what you see on the left-hand side of the screen is a document you can access from the ISSB website on how you use integrated reporting to complement your sustainability related reporting, because we know this ISSB, the IFRS, the integrated reporting framework provides this holistic view of the value creation process. So within that document, you'll find some dedicated frequently asked questions about how to use integrated reporting to support your sustainability reporting. There's a mapping tool to help in this getting started guide. I think the most important thing to say about integrated reporting, though, is of course it's underpinned by integrated thinking, which can greatly enhance the quality of a company's governance and disclosure. Let's move now to another Zoom poll. And this asks, my disclosure objectives should consider. I think you can just select one here. If we launch the Zoom poll, please, it should consider the ISSB standards. Oh, it's multiple choice. No, you can select as many as apply. The ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above and other sources of guidance. Oh, thank you to Robert for putting the exposure draft proposing targeted amendments to S2. That might be useful for you to look at if you're interested in understanding what the ISSB is considering in terms of simplification on GHG emissions reporting. Right, let's end the poll and share the results on this one. Yes, all of you really got this correct. When you're considering your disclosure objectives and what to disclose, you should consider the ISSB standards, your regulatory requirements, of course, and other sources of guidance, some of which we'll look at a little bit later. So I think I'm handing back to Landon now for our Module 2 summary.
Great. Thank you so much, Lois. So as we wrap up this module, we'll take a minute now to remind ourselves of what we've learned. So we reviewed all 4 core content areas of the ISSB standards: governance, strategy, risk management, and metrics and targets. But an important thing to remember is that these do not operate in silos. Again, you see, we've discussed a lot already this session, the interconnectivity of standards, and it's the same with these core content areas. We also saw in our examples that despite having 4 separate categories of disclosures, these are all, again, interconnected. We also discussed how your disclosure might go beyond the requirements of S1 and S2, for example, to meet different stakeholder needs, to meet regulatory requirements in certain jurisdictions, or to meet industry standards. What's important to remember when doing this is that the ISSB standards have been purposefully developed to act as a baseline, and the building blocks approach allows report preparers to add additional disclosures on top. But in doing so, report preparers need to be careful not to obscure the requirements of S1 and S2. With that, we'll go back to Menti. So you should have the link already if you don't still have it up. But the question is, what are the key gaps you need to address in your current disclosures or internal processes? This could either be gaps in internal knowledge, skills, processes, or gaps in content disclosures. So give you a minute to think about those gaps that you need to address and input your answer. Okay, lots of answers coming in. A lot of individuals are saying quantification and measurement. So that's good to see that you're thinking more about quantification and data availability. Data management is a big one and a really good answer. Yeah, a lot about quantification and data, which is positive to see. I like seeing lack of board training or knowledge. I think that's an important one as well. One I'm not seeing too much of is integration into annual report. That could be a good answer as well. Another would be connection to financial disclosures and reporting processes. So that would be another good answer as well. And I'll just show a few answers that popped up here in case you're curious. So again, we see a lot about data, a lot about quantification, knowledge and awareness. You know, that's something we're very passionate here about at the SSE. A lot about measurement. I think you can see quite clearly how much data is coming up. So we'll leave it there, but those are all good answers. So thank you for that. And with that, I just want to say it's important to consider prioritization of gaps, which are the most significant to address prior to first disclosures, which could perhaps be improved and evolved over time as reporting matures. So with that, I'll turn it back to Lois to talk through implementation.
Thank you, Robert. I was just looking at some of the questions there, which we're really pleased to see come in. So yes, as you said, we're moving on to implement now, the module called implement. And we've discussed already the disclosure requirements that really set out what a company should report, but we haven't looked so much at how companies should prepare the information that is required by the standards. So in this unit, we're going to look at three particular things. First of all, how to identify sustainability-related risks and opportunities. Secondly, some of the evaluation processes that you might use where the standard doesn't tell you what to do, but relies upon management's judgment to make decisions, and therefore you need evaluation techniques. And thirdly, how to integrate sustainability-related disclosure practices into your existing processes and practices. So let's start with identifying sustainability-related risks and opportunities. So, as I said earlier, the S1 requires a company to disclose material information about all sustainability related risks and opportunities that could reasonably be expected to affect the company's prospects. But we also know that we just have currently a standard for climate. So what about risks and opportunities beyond climate? Well, S1 recognizes that companies might need to refer to other things, so it directs companies to sources of guidance that can help them identify risks and opportunities and what to disclose about them. So first of all, when identifying relevant risks and opportunities, a company should consider ISSB standards, the standards of the Sustainability Accounting Standards Board that we saw some of you are already using. And the ISSB standards are available from the IFRS website. In addition, companies may consider other materials like IFRS educational material on sustainability related risks and opportunities and the disclosure of material information. And it would be great if we could share a link to that in the chat, perhaps Robert, because this is this is a very recent piece of educational material and very comprehensive. The standard also allows companies to consider using the CDSB framework application guidance, which covers a range of subjects, including climate and water and social subjects as well. And also companies can look at industry practice or guidance to help them identify risks and opportunities, as well as the materials of other investor focused standard setters. And we saw their logos on a screen earlier. So once you've identified which risks and opportunities you are most relevant, you then have to decide, well, what is the information and what is the material information we will disclose about that. Now, exactly the same sources of guidance can be referred to, but in addition, you can refer to GRI standards and the European Sustainability Reporting Standards if appropriate. So we're now going to look at an example from the Philippines. This comes from Ayala Corporation's Integrated Report 2024. And as you probably know, Ayala is a conglomerate organization with lots of industries, property development, banks, healthcare, technology, and so on. This example provides an overview of their risk assessment process, and it starts with a range of communication and consultation exercises with internal and external stakeholders, really to give the company this sort of background introduction to what it is that their stakeholders view as important about sustainability related risks. So informed by that consultation and communication, we move through 4 steps. The first one is to establish the risk landscape context, which considers both internal and external factors, such as organizational culture, values, sustainability objectives, and external factors, including sustainability megatrends. And we also see who is in charge of this, the enterprise risk management team. The diagram then goes on to show the steps that they follow, first of all, to assess, identify, analyze, and evaluate the risks. Then we move into a treatment part of the process where the company makes recommendations on the appropriate plan of action to address the risks in the different functional areas that it affects. And finally, they move on to the monitoring, review, and management of those issues within their wider governance, strategic, and operational processes. There's a lot more information about this in IALA's integrated report. Let's look at another example now, a slightly different approach here from a company called Nest. Nest is a company based in Finland, and it's a leading producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. And this extract shows how the company has identified risks and opportunities in two different scenarios and over a time horizon until 2050. So the first scenario is the net zero world by 2050, and they describe that as being a world where global warming aims to be limited to 1.5 degrees above pre-industrial levels. Now you'll notice that this net zero world scenario is applied on a global basis, but also at the bottom of the screen you see that it's a separate analysis done for Europe and North America. And this is because some economies take action at a faster pace, different timescales and different types in different jurisdictions. But in both cases, the company sets out the opportunities and risks they foresee in these scenarios. So on a global basis, they could expand into new markets and sectors. In the EU and US, they expect their supply of renewable and circular solutions to be supported by regulation or voluntary ambitions. They also identify risks associated with competition or the acceleration of new technologies. There's a second scenario they use as well, which is compromised climate targets, where climate action is slow and global warming is higher than in the net zero world scenario. And in this case, the opportunities that the company have are to differentiate itself from others by providing renewable and circular solutions, but the risk is that the demand for their products is constrained in that scenario. In all cases, you'll notice that on the bottom line, we see the indicative financial impact to Nest, and the most positive indicative financial impact is in the net zero world 2050 scenario. And perhaps this is understandable because their business model is focused on the development of renewable fuels and circular products. So let's move now to look at these proportionality mechanisms we've already mentioned. So despite the guidance that's available, it can be difficult, a challenging exercise to identify risks and opportunities and to make disclosures about them. So in applying the requirements, a company is required to use all reasonable and supportable information available at the reporting date without undue cost and effort. So the standard is reasonable about what you're expected to do in identifying and reporting on these risks and opportunities. So what do we mean by reasonable and supportable? Well, it's information that's specific to the company, and so not just general statements. It takes account of the external environment, as we saw in the Ayala example. It includes information about past events and current conditions the company will know about, but also forecasts, perhaps informed by scenarios, as we saw in the Nest example. And in some cases, what is proportional and what is commensurate is specified in the ISSB standards. So I'm going to hand over to Landon now for the next unit of this implement module.
Great. Thanks, Lois. And for this next segment on implement, we'll be looking at the evaluate element. So once risks and opportunities are identified, companies need to evaluate the financial effect of those risks and opportunities. This can often be the most daunting when first starting, but we'll briefly review a few key concepts that help you in this process. To help investors understand a company's resilience against climate risk, S2 requires a company to disclose information about the implications of climate change on its strategy and business model. It also asks for the company's financial and operational capacity to adjust or adapt over the short, medium, and long term. For example, you might test your company's resilience against new regulation to limit certain high emission activities, or your company's ability to respond to changing crop yields due to more frequent heat waves. To do this, you would use scenarios based on science and analyze how those scenarios will lead to the company's incurring effects and impacts. It's important to remember scenario analysis does not require you to predict the future. None of us have crystal balls, but it's a tool to test your resilience against potential future events. S2 does not specify which scenarios a company shall use in its analysis, but it does require the company to use relevant scenarios and provide information about the scenarios it has selected, and also to provide information about other relevant assumptions it's used in the scenario analysis. And S2 includes guidance on how a company can determine its approach to scenario analysis. This encompasses a range of practices from qualitative scenario narratives to much more complex statistical modeling. Considering this, the ISSB standards require a company to use an approach that is commensurate with the company's circumstances and use all reasonable and supportable information that is available to the company at the reporting date without undue cost or effort. And let's see an example now to zoom out a bit and see how this comes into our disclosures. So the example here is a company that I'm sure everyone will be familiar with, of a Swiss multinational food and drinks company, Nestle, who we'll be using as our next example. So here we see one output from their climate scenario analysis from their 2024 non-financial statement. This visual, this map here shows potential impact of physical climate changes on the yield of 12 of their key agricultural commodities for 2040 under a medium emissions scenario. The modeling metric they use here is the projected percentage change in crop yields for 2024 as compared to 2022. So the analysis projects that increased heat waves, droughts, and water stress could affect the availability and quality of key raw materials that could in turn lead to increased price volatility and input costs. Yield reductions for some raw materials may affect their supply chain stability. Their disclosure then goes on to summarize the key outcomes of the analysis for different aspects of their business and the key steps they're taking to improve resilience against those potential issues. So in response, the company has set out potential effects on business model, business resilience, strategic and financial planning, product innovation, operational efficiencies, R&D initiatives like leveraging science, for example, and engagement and advocacy. So it's pretty wide ranging how they've looked at the potential effects. Anticipating the materiality of future events can also be particularly challenging. To help with this determination, IFRS S1 asks that you consider a number of issues to help you with your determination. So you could think of this list as identifying all the steps and information you needed to come to your judgment. For example, the companies should be considering all low probability but high impact events. So any uncertainty related to the company's future cash flows should also be evaluated, for example. I will note another important point here is that there's a need to reassess at each reporting period. It's not just a one and done situation. And with that, I'll turn it back over to Lewis.
Thanks, Landon. Let's look at the last unit of this implement module now, which is about integrating sustainability-related risk and opportunity considerations into your existing processes. or whether you need to develop anything new. So there is some good news here, which is that in many companies, a lot of what you need to start working on your sustainability related disclosures probably already within your organization. But let's think about some of the considerations you might have when creating new or adjusting existing processes for sustainability disclosure. As I said, you might already have some of these processes in the form of internal controls, risk management processes, data quality processes, and so on. But let's think about an approach you might take to thinking about whether your existing processes are appropriate or sufficient. First of all, you could conduct a gap analysis to check for gaps in existing systems and processes, see if you've got everything you need for sustainability disclosure. The next two are whether the existing processes are suitable in terms of what they do and the criteria they use. So as we all know, sustainability considerations are more uncertain than certain other types of risks, and therefore the criteria you use and the processes you use might need to be different. So criteria in addition to probability, for example, might include likelihood, impact, vulnerability, and speed of onset. You may want to evaluate your existing internal controls process to see whether they are suitable for collecting and monitoring sustainability related information. Consider who needs to be involved from internal departments and externally to contribute to sustainability disclosure. What are the connections between different internal and external factors that affect your sustainability disclosure, and how can those connections be assessed and used to support your disclosure? What uncertainties have you identified, and how can they be reflected in your disclosure? And also, what resources might already be in place, or what new resources might you need for managing existing or developing new systems and processes? Might you have to go through a change management or budget request process? Now, we have referred to already your homework. Your homework is, of course, voluntary. We recommend it, but it is to develop a disclosure plan. And a disclosure plan is a great way to integrate sustainability-related risk and opportunity disclosure practices into your existing practices. So the disclosure plan helps you take control of your narrative. You'll have noticed that the disclosure requirements ask about your governance process, your strategy as a company, you know, the risks you've identified and so on. And so rather than making your disclosures general and generic, the disclosure plan means that you can be very specific to your company and take control of your narrative. A disclosure plan enables you to make a record of who is likely to be involved in contributing to your disclosures. So in that sense, it supports internal collaboration, knowledge sharing, and cross-functional team discussions with staff, but you might also want to note there who externally will be involved. So your disclosure plan would note who's going to be involved. Might it be risk management, company secretarial, procurement, finance, people from external organizations, your accountants or advisors? It also creates a reference point, an audit trail, which I think is the most important thing about a disclosure plan, including where and how judgments have been made, how data was sourced, what systems were used, whether you're going to have your reports assured, and if so, by whom, what will be the sign-off processes internally, how will different goals and requirements be managed, who is your audience. This reference point for recording all of these decisions is a very useful process as a disclosure plan. Here's an example of how a company called Novo Nordisk, which is a Danish pharmaceutical company, makes disclosures about their approach to their sustainability statement. So they're kind of setting out here what was in their disclosure plan, if you like. So what do they tell us here? Well, they outline the regulations, standards and practices that they have to or have chosen to use for their disclosures. So you can see that there's quite a long list there: the GHG Protocol, Science-Based Targets Initiative, the TCFD, the GRI, and so on. They tell us the approach and scope they use for data collection and verification. They tell us why and how changes have been made in their reporting since the last reporting period, including how errors have been corrected through restatements. They tell us how estimates have been used and where to find more information about assumptions and uncertainties. They tell us the time horizons they use for preparing information. So, as Landon said earlier, the standard doesn't set out the time horizons in terms of what period they relate to. So, in this little statement here, Novo Nordisk tells us that the time horizons are 1 year is short term, 1 to 5 years is medium term, more than 5 years is long term. So you can see, can't you, that having this all agreed before you start the reporting cycle is quite useful. It gives you that stable basis for approaching your reporting. So get it done early, we would recommend. But also, most importantly, it really helps the readers of your report understand the basis for how you have prepared it. Let's do a Zoom poll about disclosure plans now. So hopefully we launch the Zoom poll and you see it on your screen. And the question is, you can only select yes or no. Is a disclosure plan required by the IFRS sustainability disclosure standards? You can either select yes, and you must disclose your plan, or no, but it's a very helpful tool. I can feel lots of thinking going on here. Let's end the poll now and share the results. Well, this is a very, very good audience, because you are absolutely right. Not all of our audiences get this question right. You are right. There is no requirement in the ISSB standards for a company to have a disclosure plan or to disclose details about it. There are requirements that say you must set out the methodology on which you've prepared certain disclosures, but there's no requirement for a general disclosure plan. So well done to most of you that got that right. No, you do not have to have a disclosure plan, but we recommend it as your homework because we think it's a very useful tool to help you as you prepare your disclosures. We've got one more Zoom poll now to end this part of the implement unit. So select all that apply here. A disclosure plan can help a company take control of its narrative within general purpose financial reports, support collaboration, knowledge sharing and cross-functional team discussions, act as a reference point and audit trail for disclosure preparation, or skip full disclosure as prescribed by the ISSB. I can tell already that this is going to be, you're going to get the correct answer. So nice to see so many of you participating. Thank you. As presenters, we really appreciate the interaction. Here we go. Yes, a clear pattern here. Yes, of course, you're all right. It does all of the first three things, and a disclosure plan, if you have one, cannot be used as a reason to skip full disclosure as prescribed by the ISSB. So well done, right again. And I'm going to hand back to Landon for a summary of Module 3 now.
Great. Thank you, Lois, for that. And as we wrap up this module, let's just remind ourselves of a few key things. Firstly, let's come back to those connections. So in the last module, we wrapped up by highlighting the importance of connections and interconnections between those four core content areas of disclosure. We then learned in this module that there's many connections as well between a company and its external and internal environment. These connections are what we need to focus on to identify key risks and opportunities. The second thing we discussed in this module was related to evaluating those risks and opportunities, and a key component of that evaluation is consistency in your assumptions. So using a scenario analysis can be a very helpful tool, as we discussed, as it helps keep track of those assumptions. And if you're new to this, pre-packaged scenarios such as those from NGFS can even provide you with assumptions that can be used for evaluation of financial effects. Finally, as we've seen, even if some of this data is not data you're already disclosing, you may already be collecting it for different reasons, or you may have the appropriate practices or processes in place to collect the data you want to report. You just need to make slight adjustments. So there's no need to start from scratch if you already have some of the processes and data in place. Now, as we wrap up this section, we'll go to a activity. Actually, yeah, we'll go to a Menti rather than activity just for the sake of time. So what existing systems and processes for data collection can be adapted to collect data on sustainability related metrics? So we'll give you a minute or two to input some answers there on the Menti. I'll share the Menti here with you all now, so that if you're curious about what answers are coming through, you can see. So again, the question was, what existing processes for data collection could be adopted to collect sustainability related data? Database management systems, absolutely. That's a good answer. Absolutely. More on ESG database, absolutely. If you have a database, an ESG data management system in place, utilizing that is absolutely helpful. So using as well an existing ERM or enterprise risk management process, you could also include sustainability related risks and opportunities into the existing ERM practices. And then give it 1 minute or a few more seconds to see if anyone thinks of another key one that I want to mention, but I'll see if anyone beats me to it and mentions it. Okay, I'm not seeing one of the answers that I thought might come up, but that's okay. There's a lot of good answers here. The other answer I was going to mention is governance structures. So you can use the same governance structures that were set up for TCFD, which can now be adapted for ISSB S1 and S2. So I don't think I saw that one come up, but that's another answer you can use. But a lot of good answers there. So I'll switch back to the slides now, and then I'll turn it over to Vanessa to start taking us through the next section.
Okay. Thank you, Landon. And we're almost there. I'm sure I can see a lot of enthusiasm from the Menti. So we are now, Landon, could you, share the screen? Yeah. So we are now moving on to the final unit of the training, which focuses on the when and where of disclosure of sustainability related financial information. So for the last unit, we will have 3 main sessions. To get us started, we will look at the location. In this session, we are looking to clarify where sustainability disclosures should be located. Before we dive into the specific requirements, let's think about sustainability disclosures in the context of a complete reporting package that is useful to investors. Investors already have access to a company's financial statements. ISSB standards are designed to identify sustainability-related risks and opportunities that complement the financial statements. This all come together in a reporting package that we call general purpose financial reports. The requirements in ISSB standards about what information to report are based on existing sustainability reporting regimes, focus on investor information needs and on aspects of financial accounting standards. GRI standards expand on sustainability metrics relevant to broader social concerns. ISSB and GRI reporting standards share some content requirements, such as what to report. However, the ISSB standards are focused only on investors' information needs and decision-making, reflecting the mission of the IFRS Foundation. So our mission of the IFRS Foundation is to bring transparency, accountability, and efficiency to capital markets around the world. Both organizations take different approaches to define materiality, but they are not competing. The GRI approach is set out and understood among sustainability practitioners, whereas the IFRS approach is familiar to accountants and relies heavily on management judgments, aligning with existing corporate risk management process. Together, these frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, aligning both investor priorities and broader social expectations. A simple example is where a double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they are important to disclose to investors. Moving on, as we just noted, materiality has different definitions for different reporting standards and audience. So let's briefly recap what we mean by material information of the IFRS. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospectus. Once the company has identified those risks and opportunities, it can then determine what information to provide about those risks and opportunities. This is where we define material definition. The definition of material information used in S1 is based on and aligned with definition found in the IFRS accounting standards. It is information that, if omitted, misstated, or skewed by other information, could reasonably be expected to influence investor decisions. So in other words, the ISSB standards seek to identify disclosure of key information that matters to investors. An entity determines what constitutes a sustainability-related risk or opportunity based on its facts and circumstances. Entities often have well-established process for identifying, assessing, and responding to sustainability-related risks and opportunities as part of the management of their business. So moving forward, investors have asked for disclosure of material information, and the ISSB standards have been designed to help you gather and disclose it. However, this means that a company does not need to disclose information that is not material, even if the ISSB standards include it as a specific requirements. Remember Remember to ensure material information is clearly identifiable and that you use plain language. Ensure material information is not scattered across your disclosure. Include any additional or non-material disclosures if required by the regulators, but ensure it is clearly identified as well. The IFRS has also recently released further education material providing guidance for companies on identifying and disclosing material information on sustainability-related risks and opportunities, which we will encourage you to look at for further details. So now let's take a pause, and we'd like to jump to another Zoom poll for refreshing our understanding of the material information. So the question is, the information should be disclosed in the annual report when applying ISSB standards if select or that apply. A, omitting the information could reasonably be expected to influence investors' decisions. B, it could reasonably be expected to affect the company's cash flows. C, it exemplifies the values of the leadership team. So we are now approaching to around 40% of participation. Now we can see like the trend, and like it's like a rising trend from A. So the correct answer, I think we'll just take a pause here. So the correct answer, I'm assuming, is that O, but C. It's A and B. So let's take a stop the Zoom poll. Okay. So the reason why for that is that unless it has been determined that the particular values being exemplified are expected to have a financial effect on the company, this may not be information that is necessary. Okay, moving forward, the disclosure under the ISSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package. But S1 does not say where in that reporting package the information shall be provided. This is designed to allow jurisdiction-specific requirements on the location of reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as part of the same reporting package as the company's financial statements. Sustainability disclosure must be provided at the same time as the related financial statements, cover the same reporting period as the financial statements, and authorized by the same body or individual authorizing the financial statements. The research by WBCSD on the state on the state of integrated reporting shows that nearly 2/3 of companies continue to put sustainability information in their standalone reports. However, the ISSB standards require material information related to financial disclosures to be included with the general purpose financial reports. This suggests many companies have some way to go to get their internal processes and disclosure plans aligned. So let me hand over to Louis for further example.
Thank you, Vanessa. And again, we have an example from Ayala in the Philippines. So this is from their 2024 integrated report. Now, the report itself is about 220 pages long, which is really short for a company of this size and complexity. But they put a lot of information on different things in their report about the business, the board and management, impacts including on climate and people, the group's value creation approach. And we see that summarized in this extract. So as well as summarizing the value creation approach, the diagram acts as an index to help readers find information in the report. So in the middle circle, you can see the page numbers indicating where information appears on the outlook, material topics, stakeholders, strategy, and so on, but also as a navigation tool to help companies to help readers find information in this report. You see these symbols. There's a symbol with a little skull with a wheel inside, and that's to show that it is a disclosure about the focused execution of the strategy. So we've got in one little extract a summary of the value creation process, an index mechanism, and symbols to help with navigation. But of course, this is really comes from a PDF report, but perhaps in future we'll see more digital reporting, which Vanessa is going to talk about now.
Yes, thank you. So we are now notifying technology is an emerging consideration for disclosures. Increasingly, corporate reporting is moving from PDF reports towards information on web pages with structured data sets, such as those data sets offered by stock exchanges. The IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials of the ISSB standards. So the taxonomy does not introduce any new requirements. A digital taxonomy provides the common elements or text needed to make your sustainability disclosures machine readable. This makes it easier to take large data sets, like information from an entire industry, or bring them all together to analyze them. Digital reporting has a number of benefits. Firstly, it makes the reported information easier to use for analysis. Data is structured the same across business in a machine-readable format. Secondly, tagging information potentially allows for automated checks for quality and consistency. Thirdly, more and more data connection and management systems are compatible with digital reporting taxonomies, improving processing and report preparation. And lastly, text can have labels and descriptions in multiple languages. If you report your qualitative data in one language, someone speaking another language can also understand what it means. Following the discussion on the location and timing, let's now think about ensuring efficient disclosures. We added this to the training because a common comment we found from the corporates is that there is a growing reporting burden. What we hope to highlight is that when done correctly, efficiencies can be made to reduce the burden. First of all, it's important to understand what effective information looks like and what it is required. Often companies think that if they just put all the information they have into one report, that everyone will be satisfied. However, this would be against the core concepts. In particularly, fair presentation, for example, it could be helpful to ask these questions. Firstly, is the information clear and concise? Clear means might depend on the nature of the information. For example, whether it could be clear to present information in tables, graphs, diagrams, or plus accompanying text. Second, concise. To be concise, disclosures need to avoid boilerplate information, unnecessary duplication of the information, and to use clear languages. Some preparers, like watching today, might be thinking to themselves that they still don't see what all the fuss is all about. Perhaps their experience focuses on standalone sustainability reports, or they haven't had much interaction with external audit. To the accountants watching, I say be kind to your colleagues. I say you need to be kind to your colleagues, help them understand the difference in rigor that's required in data connection, oversight, sign-off, etc. for financial statements. This means, for example, disclosure include comparative information and are to be restated as necessary. Secondly, disclosures avoid less unnecessary duplication and cross-reference as required. And lastly, information has to be material, be connected, and aggregated or disaggregated appropriately. As you may have already noticed, there may appear to be some overlap in the disclosure topics. For example, you might have the same governance approach for all sustainability issues rather than duplicate certain information. You can use cross-referencing to enhance efficiency of your disclosures. Cross-referencing to other reports is permitted as long as the other report is available on the same terms and at the same time as the sustainability disclosures. The cross-referenced information is assumed to become part of the reporting package. Cross-referencing shall be applied consistently and transparently. It shall not result in the information becoming more difficult to understand. Now, let me invite Lewis again for further examples.
Thank you. Thanks, Vanessa. And we have an example now from a company called ArcelorMittal. And ArcelorMittal is a steel manufacturer. And we're looking here at what cross-referencing actually looks like. ArcelorMittal's reporting is very extensive, and they've used this table here to show readers how they've organized information, including how they cross-reference to other information from their sustainability report. So you can see down the left-hand side, we've got the IFRS content elements and concepts that we're all familiar with now. We've been talking about these today. And you can see where they cross-reference to where their response on each of these content elements can be found. So if you look at risks and opportunities, for example, they refer us to the governance and risk management in the 2024 sustainability report. So that's cross-referencing within the report. But if you want to know more on risk management, they cross-reference to outside the report into their Form 20F filing. Similar in strategy and resource allocation, they're referring both within the sustainability report, but also to the annual report and Form 20F. So that's how ArcelorMittal's done it in this nice, neat little table. Back to you, Vanessa.
Thank you. We have sought to apply a number of mechanisms to support preparers to get started with the ISSB standards. Firstly, one simple thing put in place was to adopt well-known terminology and concepts familiar to preparers, borrowing from IASB, for example. And many requirements in S1 and S2 are to be applied proportionately. Recognizing companies will have a range of capabilities and preparedness on these issues. For example, qualitative scenario analysis is permitted, and you will see the phrase all reasonable and supportable information at the reporting date without undue cost or efforts, or commensurate with skills, capabilities, and resources in a number of places. And thirdly, reliefs for the third year of application have also been introduced and include companies being able to limit disclosures to climate in year one and begin reporting on their other sustainability report related risks and opportunities in year two. And then companies being able to provide annual sustainability-related financial disclosures with their next half-year reporting rather than at the same time as the financial statements. And lastly, companies not needing to provide disclosures about Scope 3 GHG emissions, applying the GHG protocol corporate standards to measure emissions if they are already using a different measurement approach, or provide comparative information in their first year of reporting using S1 and S2. And moving forward, another relief shows companies to include GHG emissions information obtained from companies in the value chain with a different reporting cycle. And lastly, we've already mentioned a number of other other sources of guidance and resources, including ISSB standards, CDSB framework, application guidelines, among many others. Among those released are designed to enable companies to put in place reporting practices and structures to provide high quality, decision useful information. Jurisdictions will decide when to mandate adoption, but the standards are effective from 2024, January 1st, and we know many companies are now preparing to adopt them voluntarily. And now let's moving forward to another Zoom poll to further understand the disclosed information. So the question is, information disclosed in accordance with the ISSB standards should be A, decision useful, B, material, C, misleading, and D, comparable. So let's see. Yeah, let us see your results. Sorry. So we are now having almost like 50% of participation. I'm glad that only 1% like choose the wrong answer. So the correct answer is all but C, but we still see like 2 select misleading. So the correct answer is like decision useful, material, and comparable. And now we are more like I said, okay. And now we are moving forward to our next Zoom poll. The question is, information is decision useful if it is A, relevant and faithfully represent what is purposed to represent, B, comparable, C, verifiable, D, timely, and E, understandable. Now, let's wait to see whether you have listened carefully from what I just presented. And now we are approaching almost, okay, over like 50% participation. Okay, yeah, we are glad that like the answers is all. So we can see like the similar trend of among all the answers. So good luck to, so congratulations. And I think you're all getting that. So moving forward, finally, the last section of our unit blocks to help you can ensure that the users of financial reports have confidence in the data you are disclosing, as trust is an essential part of sustainability-related disclosure, and increasingly so with the growing concern over greenwashing. An important trust builder is showing data and trends over time. That is why ISSB standards ask for comparatives. So comparative information provides context, helps to indicate progress, and underpins strategy and risk management. Metrics disclosed by a company might be redefined or replaced over time, or the company might change its methods for estimating a metric. In these situations, It is important for the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant period figures. Occasionally, a company's sustainability disclosures might contain material errors. In this situation, the company is required to restate these errors in the comparatives we provided. And fourthly, revisions or restatements are necessary only when there is a risk that material information being omitted, misstated, or skipped as a result of not revising or restated the comparatives. Information can be qualitatively or quantitatively. Companies sometimes express concern with sharing information they deem to be sensitive or that, if shared, could deplete their competitive advantage. The ISSB standards relieve a company from disclosing information about a sustainability-related opportunity if that information is commercially sensitive. If that is a concern you may have, that there is a further detail you can read in the handouts. And finally, it's important to build confidence by providing clear statements of compliance. A company that complies with all requirements in the ISSB standards, even the release, is required to make an explicit statement of compliance. We also published further guidance on this in September 2024, called Voluntarily Applying ISSB Standards, a guide for preparers. And lastly, my final reminders to share with you all. The first one is that work through the list we share on this page, and you can find in the handout slides addition slides in this section with reminders of how to report effectively. And I really highly recommend all of you can take a look at that. And now let me hand over back to Landon for the wrap up.
Great. Thank you so much, Vanessa, for taking us through the communication section. So that is our final module. And before we wrap up, let's just take a quick moment to recap what we went through in that module. First, we discussed where to report information, and what was important here was the audience or who you're reporting to. So make sure to be clear from the start who the primary user of information is, and that will help you ensure that this information is the right information for their needs. We also discussed efficiency, and I think the key takeaway there is less is more. So the objective is not to overload investors with information that can actually be harmful, given it could obscure the good information that's required. And using the standards as you get started can be a good guide to make sure that you're providing what information investors need, which is of course the purpose of the ISSB standards. Finally, we discussed report user confidence, especially in the current climate of greenwashing accusations and legal battles over public statements. You want to ensure that your data is not only accurate, but it is presented in a way that builds confidence among report users. The reporting plan that we've been discussing can help you to do this, as if it's done well, you'll have a clear and documented process for reporting the data that investors need. Now, as we wrap up, we'd like to get a sense of how we did with this training. So I have here a few more Menti questions for you to answer. So we'll just go to the Menti here. So the first question is, how comfortable are you with each of these tasks now after the training? So explaining to team members what the ISSB is, using the ISSB standards, and developing a sustainability reporting strategy. Okay, seeing a lot more comfort. A lot of folks are indicating more around 3.5, and I think from memory we started a bit closer to 2.2. So it seems like the training has been helpful so far. But as I mentioned, we don't expect you, if you're not already an expert, to be an expert by the end of the training. But we hope that it's at least a substantial improvement or helpful for your learning and skills. The next question we have is, what do you think was the best part of this training? And then what could be improved in this training? So for the sake of time, I won't go through all of those, but if you don't mind just giving some answers while I wrap up here, that would be great. We really appreciate getting that feedback from our participants, as we're always looking to evolve and update the program and make tweaks so that the training is even more helpful and effective. So with that, we do have a homework assignment, which is developing a draft disclosure plan for your company using what you've learned in this training program. So you'll see that the homework assignment follows the same structure as the interactive Menti exercises we've been completing in today's session. It takes you through considering the 4 key steps with prepare, align, implement, and communicate. So if you follow through the structure of the assignment, it will help enable you to develop your first draft ISSB aligned disclosure plan for your company and allow you to put into action what you've learned during today's training. So we encourage you to do that today in your own time. Also, don't forget to make use of the IFRS Knowledge Hub, which I know we've shared throughout, but as mentioned throughout and at the beginning, this hub is regularly updated with relevant resources, so please feel free to share it with colleagues and within your market. A lot of very helpful materials, a lot of which we shared today, but a lot of which we didn't specifically link to. You can also share with your market this great resource by the IFC, or share rather with colleagues, which collates a broader set of resources related to sustainability, governance, and disclosure. And as a reminder, the SSE is working closely with the IFRS Foundation and other partners to support exchanges on this topic. So we have an online toolkit now that you can use as you start to guide your market on the ISSB standards, which includes training, a model guidance, and the training tools. And as a reminder, if you know any other folks that are interested in training, please point them to the UN SSE for future trainings. Next, oh, sorry. So those are just some of the tools I just mentioned. And next, the certificate. So well done to everyone who stuck through the full 3.5 hours of training. I know it's a big commitment and a lot of information, but hopefully it was helpful. And there was a lot to learn, and we're very appreciative of all of you who asked questions and interacted throughout this training. I know when there's higher participation, it makes it more fun and enjoyable for us facilitators as well. So as a merit to your hard work, you can now receive a certificate for completion of this course, which is CPD certified. You just have to fill in a feedback survey using a link in the chat. We'll also email you this link tomorrow via Zoom in case you miss it here. So don't stress if you miss the link in the chat. You'll get an email, so look out for that email as well. That will come via Zoom. So once you complete that short feedback survey, you'll receive your certificate generally within a week. If you're missing it after, say, 5 working days, 5 business days, be sure to check your junk folder because unfortunately sometimes it goes to your junk or spam by mistake. But please give us about a week to get those certificates out because there's about 400 participants. So it's a lot of certificates for us to get out. So please be patient. But if you haven't heard from us after a week, please feel free to send us an email to make sure there's no issue. But your certificates will be coming. Now, before we close, we have a few words of appreciation. First of all, a big thank you to all the SSE supporters you see here on the screen. This group of stock exchanges and organizations committed to promoting sustainable capital markets and has made our training work possible. As a reminder, supporters receive early access to all our training programs. It's great, and we've always also appreciated the Philippine Stock Exchange being a member of the SSE, but we always encourage additional collaboration. With that, we'd also like to thank our great partners at the IFC and, of course, the IFRS Foundation, like Vanessa and Robert, who joined us today, who are fantastic subject matters. So thank you so much for sharing your expertise with all of us here today. And of course, a big thank you to everyone who joined. Have a great day, everyone. Salamat po. Bye-bye.
Bye bye.